Welcome back to BD Daily Finance News Podcast, your daily shot of markets, economy, and investing for the 23rd of November 2025. Today we're unpacking the AI stock wobble after Nvidia's latest earnings, a potential Fed pivot shaking up silver and bonds, surprisingly sturdy U.S. retail sales, a possible comeback for beaten-down small caps, and a brand new IRS crackdown on crypto taxes.
We've also got Bitcoin on track for its worst week since March, retailers trying to calm nerves about lower-income shoppers, and some big questions about whether the so-called AI bubble is already deflating. So if you've wondered whether to buy the dip in chips, rotate into small caps, or finally clean up your crypto tax reporting, stay tuned.
Quick snapshot before we dive in. U.S. stocks just came off roughly a 2% weekly drop in the majors, even after strong earnings from names like Walmart and Nvidia. The VIX is elevated but not panicky, and Fed funds futures now price around a 70+% chance of a December 2025 rate cut after dovish comments from New York Fed President John Williams.
And in commodities, silver volatility has spiked as traders bet on that rate cut, while the dollar has softened just enough to give precious metals and some emerging market assets a breather. So the big theme today is simple. The AI dream is colliding with the interest rate reality.
Let's start with Nvidia, because Wall Street basically threw it a parade and then forgot to show up. The headline, Nvidia posted blowout earnings again, but as one piece put it, Nvidia didn't save the market. And investors are still nervous about an AI bubble.
Right. You had revenue and profit growth that would make most CEOs weep with joy, but the stock reaction was muted and broader indexes still fell. That tells you expectations were already sky high, and the market is now asking, how long can this AI capex boom last before we hit saturation or regulation?
There's also this nagging worry that AI spending is peaking. Another note this week talked about fears of peaking AI investment hurting sentiment, even as earnings beat. It's like the market is saying, great quarter, but can you do that forever while rates stay high and customers build their own chips?
Exactly, because when you see a 2% drop in the S&P 500 for the week, despite stellar AI headlines, that's positioning and macro overpowering micro. For listeners, the takeaway is that even the best company in the hottest theme can't defy gravity if the broader market starts de-risking.
So if you're holding AI names, this is where risk management matters more than hot takes on social media. Think position sizing, diversification, and timelines longer than one earnings print. Not all in, because my cousin's Discord said AI only goes up.
And ask yourself, what has to go right for this stock to justify today's price? If the answer is everything, forever, that's a bubble-ish setup, even if the company is genuinely great.
Sticking with AI, another big theme is the rise of custom chips. One report highlighted that while Nvidia is still king in AI GPUs, hyperscalers like Google, Amazon, Meta, Microsoft, and even OpenAI are rolling out their own custom AI chips.
These are essentially application-specific integrated circuits, or ASICs, tuned for their own workloads. Google has TPUs, Amazon has Trainium and Inferentia, Meta is working on in-house silicon, and Microsoft's got its own AI accelerators. The strategic goal is to reduce dependency on Nvidia and lower long-term costs.
So, for investors, the question is, does this kill Nvidia's moat or just trim its margins over time? Because in the near term, demand is still off the charts, as one CEO put it. But long term, those big customers don't love being locked into one supplier forever.
I'd frame it as a slow erosion risk, not an overnight collapse. Custom chips are expensive to develop and still rely on similar manufacturing bottlenecks, but they do give the hyperscalers bargaining power. If you own Nvidia, you're really betting on its ability to keep innovating faster than its own customers can vertically integrate.
And if you're more conservative, that might nudge you toward a basket of AI beneficiaries, cloud, software, networking, rather than one chip titan. Diversifying your AI exposure can be less stressful than watching a single name swing 5% on every headline.
Exactly. And remember, not every AI winner has AI in the ticker. Data centers, power infrastructure, and even industrials tied to chip equipment can all participate without the same concentration risk.
Zooming out from stocks to society, the head of the world's largest sovereign wealth fund, Nikolai Tangin, warned that AI could deepen inequality. He said differing access to AI has the potential for splitting societies, which is not the feel-good line you put in a marketing brochure.
No, but it is realistic. If large firms and wealthy countries harness AI to boost productivity and profits, while lower-income workers face job displacement without retraining, you widen the gap. From an investor perspective, that means more political risk, more regulation, and potentially higher taxes on the winners.
It also feeds back into consumer demand. If AI helps companies cut costs, but households feel squeezed or left behind, that can cap revenue growth in the very sectors investors are chasing. So inequality isn't just a moral issue, it's a cash flow issue.
Exactly, and we're already seeing early signs. Record corporate profits in some sectors, while surveys show fewer than half of Americans feel financially secure. As an investor, you want to watch for companies that pair AI adoption with credible plans for workforce upskilling and social license, not just cost-cutting.
Speaking of risk, another headline this week. Major insurers like AIG, Great American, and W.R. Berkley are seeking permission to limit their liability from AI agents and chatbots. Translation: the people who literally price risk are saying, "We're not sure we want this one."
They're worried about multi-billion-dollar claims if AI systems misbehave. Think automated trading errors, biased lending decisions, or chatbots giving harmful medical or legal advice. When underwriters start carving out AI exclusions, that raises costs for companies deploying AI and could slow adoption in regulated industries.
So from a portfolio angle, this might favor firms with strong governance and internal risk controls because they'll get better insurance terms. And it's another reminder that AI isn't just a growth story. It's a liability story too.
Exactly. And if you're researching AI-heavy companies, it's worth skimming their risk factors and any disclosures about insurance coverage. The boring footnotes can tell you a lot about how management really thinks about downside scenarios.
Let's pivot to the Fed and silver. One report flagged a time of higher silver volatility as markets price in a December 2025 rate cut. Dovish signals, bond moves, and inflation data have traders suddenly re-rating precious metals.
Right. We mentioned earlier that odds of a December cut jumped back to roughly 73% after comments from Fed officials like John Williams. Lower expected real yields tend to support gold and silver, but silver is more volatile because it's also an industrial metal tied to solar panels and electronics.
So you've got this cocktail. AI data center build-out boosting industrial demand, a potential Fed pivot helping the monetary side, and traders crowding into the trade. That's a recipe for big swings in both directions.
If you're tempted by silver, consider position size and time horizon. It's historically about twice as volatile as gold, so a small allocation can move your portfolio more than you'd expect, and you want to avoid levering up on a narrative that hinges on one Fed meeting.
And for bond investors, the same Fed story matters. If the market is right and cuts are coming, longer duration bonds and growth equities can both benefit. But if inflation surprises on the upside, again that 73% probability can vanish fast.
Exactly. Which is why dollar cost averaging into duration or metals can be less stressful than trying to nail the exact meeting when the Fed pivots. Think in scenarios, not certainties.
Over to Main Street, U.S. Retail sales growth likely moderated a bit in September, but still capped a solid quarter. Consumers are spending, but they're frustrated by high prices and increasingly anxious about job security.
We're seeing that split in earnings commentary. One preview noted that retailers like Burlington, Kohl's, and Best Buy are trying to downplay worries about lower-income shoppers even as bargains reign supreme. Translation: promotions are back in a big way, and margins are under pressure.
There's also a shift towards secondhand shopping for the holidays as fears about a sketchy economy grow. More households are hunting deals at thrift and resale platforms instead of paying full price at big box stores.
For investors, that means being careful with broad retail exposure. Discounters and off-price chains can outperform when budgets tighten, while mid-tier retailers that are neither cheapest nor premium can get squeezed from both ends.
And if you're a consumer listening, this is your reminder that chasing every deal can still blow up your budget. The best bargain is the thing you don't buy because it doesn't fit your plan.
Exactly decide your spending limits before you see the sale, not after the algorithm has already pushed the flash deal notification to your phone.
Let's talk small caps. One analysis pointed out that small stocks have lagged large caps for years, and the question now is whether they can finally beat the odds. Historically, small caps often struggle after long stretches of underperformance, but they can also snap back hard when conditions turn.
Right now, small caps are dealing with higher borrowing costs, more exposure to the domestic economy, and less pricing power than mega caps. But if the Fed really is on the verge of cutting and growth stays positive, that combination can be a sweet spot for them.
Valuations are another part of the story. After years of underperformance, Many small-cap indices trade at noticeable discounts to large caps on forward earnings. That doesn't guarantee a rally, but it does mean expectations are lower, which can be your friend.
If you're considering small caps, diversification matters even more because single-name risk is higher. Using an ETF or a broad fund can give you exposure to the factor without betting the farm on one highly leveraged regional industrial you found on a message board at 2 a.m.
And keep an eye on credit conditions. If lending standards tighten and defaults tick up, small caps feel it first. So this is one area where macro and micro are glued together.
Exactly. Small caps are like the economy's early warning system. When they start to outperform sustainably, it often signals improving risk appetite and confidence in domestic growth.
Over in crypto land, CoinDesk highlighted that Bitcoin is on track for its worst weekly performance since March. U.S. Demand indicators are weakening as the Coinbase premium declines and spot ETFs see outflows.
The Coinbase premium is basically the difference between Bitcoin prices on U.S. exchanges like Coinbase and overseas venues. When that premium shrinks or turns negative, it suggests U.S. buyers are less aggressive or even stepping back, which lines up with risk-off sentiment we're seeing in equities.
So the digital gold narrative is being tested again. When stocks fall and Bitcoin also falls, it's acting more like a high beta risk asset than a safe haven, at least in the short term.
Exactly, and that means your crypto allocation should be sized like a speculative growth position, not your emergency fund. Volatility cuts both ways, and drawdowns of 50% or more are a feature, not a bug, in this asset class.
We also saw a wild technical incident on Cardano, where the network temporarily split into two chains after an attacker used an AI-generated script to exploit a known bug. It was resolved, but it's a reminder that smart contract platforms have real operational risk.
And that's exactly why due diligence in crypto has to go beyond price charts. Network security, governance, and how fast the community patches vulnerabilities all matter if you're going to allocate real money there.
On top of price pain, the taxman is coming. A new IRS requirement kicks in for crypto transactions, starting with the 2025 tax year, and it's being described as a crackdown on a popular crypto tax cheat.
The core idea is that more intermediaries think exchanges and certain platforms will have to report detailed transaction data to the IRS, similar to 1,099 forms for stock trades. That makes it much harder to hide gains or rely on incomplete records when you file.
So if you've been casually swapping tokens, yield farming, or moving assets between wallets without tracking cost basis, 2025 is not the year to wing it. The risk of audits and penalties goes up when the IRS has a clean data trail and your return doesn't match.
Practical steps. Start using reputable crypto tax software. Consolidate activity on fewer platforms if possible, and talk to a tax professional who actually understands digital assets. Waiting until April 2026 to reconstruct years of transactions from old wallets is a recipe for headaches.
And remember, tax rules can change your net returns as much as market timing. A strategy that looks great pre-tax can look mediocre once Uncle Sam takes his cut.
Exactly. So think of compliance not as a burden, but as another lever you can pull to optimize your long-term results, just like fees, diversification, and asset allocation.
Before we wrap, a quick hit on stock picking. One roundup of top Wall Street analysts highlighted 3 favorites for upside potential, including Microsoft and Booking Holdings, while another headline asked whether Berkshire Hathaway's new Alphabet stake signals a higher risk tolerance in Omaha.
When you see Buffett's shop leaning more into big tech, that's notable, given his historic skepticism. But remember, even top-ranked analysts and legendary investors get things wrong. Use their picks as research starting points, not as automatic buy signals.
It does reinforce a theme, though. High-quality, cash-rich tech platforms with durable moats are still core holdings for a lot of long-term capital, even after recent volatility. That's a good reminder not to let one rough week chase you entirely out of the market.
Exactly. The real edge is usually time horizon, not secret stock tips. If you can stay disciplined through drawdowns, you're already doing something most traders struggle with.
All right, let's land this plane with a quick recap. AI is still powerful, but no longer bulletproof in the market. The Fed's potential pivot is driving volatility in silver and bonds, U.S. Consumers are hanging on but trading down. Small caps might be setting up for a turn if rates fall, and crypto investors need to brace for both price swings and stricter IRS reporting.
Action items for you. Review your AI exposure and position sizes. Decide whether you want any small cap or silver allocation before the next Fed meeting. Tighten your holiday budget instead of assuming the credit card will save you. And start organizing your crypto records now, not next tax season.
And if you enjoy getting this kind of daily rundown without doom scrolling through 50 tabs, hit that subscribe button for BD Daily Finance News Podcast. Drop a comment with the one move you're considering buying, the AI dip, rotating to small caps, or cleaning up your crypto taxes, and we might break it down in a future episode.
Also, tell us what you want more of. Deep dives on specific sectors, step-by-step portfolio tips, or explainers on things like options and bond ladders. This show is for you, so your questions really do shape the next episodes.
As always, nothing you heard today is personal financial advice. Markets change fast, your situation is unique, and you should talk to a qualified professional before making big money moves.
We're here to give you context, questions to ask, and a little bit of calm in the middle of the noise, not to tell you what to buy tomorrow morning. Keep your time horizon long and your curiosity high.
That's it for today's BD Daily Finance News Podcast for the 23rd of November, 2025. Thanks for hanging out with us, and we'll be back tomorrow with more on markets, the economy, and the investing stories that actually matter.
Until then, manage your risk, question the hype, and remember, in finance, boring and consistent usually beats flashy and fragile. See you next time.